What's going on, Bat fam? Welcome back to the Build a Trader YouTube channel. In this video, I'll be doing a lower time frame market structure video. The last one that I made had a bunch of annoying clicking sounds. This one is going to be much more precise, a lot better and more direct. And after this video, I'll be making another time frame correlation video without the clicking sounds as well. But in this video, lower time frame market structure. So let's dive in here. Okay, so if you don't already know what market structure is or how the market moves, you should watch my earlier market structure videos. However, I'll do a quick recap. So there's a few things we're looking for on these lower time frames, right? And higher time frames, because they all correlate with each other. It's a universe within a universe within a universe. Okay, so here we have our classic uptrend of higher highs and higher lows, right? So uptrend. See that this point right here is higher than this point. This low point is higher than this point on the left, and this point right here is higher than this point on the left. So this high is higher than this high. This low is higher than this low. This high is higher than this high. Higher highs and higher lows for an uptrend, okay? Downtrend. Lower highs and lower lows. Lower high, lower low, lower high, lower low. Oops. Downtrend. Now there's two other situations you need to be aware of, right? So, from a downtrend to an uptrend is what I'm going to be drawing next. So downtrend, lower high, lower low, lower high. When it goes from a downtrend to an uptrend, we make a higher low point, or we don't break this low point. We don't make a new low point. So I'm going to just make this right here, higher low, higher high, higher low, higher high. Okay, so I'm going to label this as bearish to bullish transition. And as you can see, the market was bearish. This is making lower highs and lower lows. We made a higher low, higher high, higher low, higher high, right? We transition from bearish market structure to bullish market structure. Okay. As you can see, this bearish structure was broken in this example with the arrows I'm making. Went from bearish to bullish, okay? Next, last example that you need to know of is a uptrend to downtrend from bullish to bearish transition. Okay, so high, higher low, higher high, higher low, higher high. And after that, we have a higher low point, and then boom, a lower high. And after that, lower low, lower high, and a lower low point. Okay, so this would be your textbook example of a bullish to bearish transition. As you can see, if you understand market structure, there's a higher low point. This point was broken to create a new lower low point, and then made a lower high to make a new lower low. Okay, that's essentially a textbook example of this. Now I'm going to be showing more in-depth examples on the chart, but if you do not know this concept, take a screenshot of this, because this is the whole entire video right here. Okay, just understanding lower time frame structure, how it correlates with the higher time frame candles and higher time frame structure, okay? All right, moving on. We're going to start with the daily time frame. Right now we're on the weekly. We're looking at the US dollar against the Japanese yen. And this is a pair that I trade often. This is one of my main pairs. I don't really trade too many cross pairs. I just mainly focus on the major currencies in the foreign exchange market. So, okay. Now, I'm going to be going over some concepts here that I've already introduced, such as support and resistance and key levels, this and that, because market structure lines up with support and resistance and key levels. You know, everything I've been saying and showing you guys and teaching, they all build on top of each other, and all these concepts all go hand in hand. Now, you can see here on this daily time frame, we're gonna start here. This huge bullish move, right? In this, all these bullish candles is lower time frame structure. What is it doing on the lower time frame? How this red arrow I just drew, this is what it's doing on the lower time frame, essentially. Making higher highs and higher lows. It might not be this clean, there might be, you know, some single candle pullbacks, but essentially that's what it's doing on the lower time frame. So we're going to go down to lower time frame, such as the 4 hour, and see what's happening. Now, as you can see, my example I just drew on the right is not necessarily as clean cut as it is on the left, right? But as you can see, it's moving in waves here, in a series of higher lows and higher highs in order to make this uptrend, make this bullish move. I'm going to go down to a lower time frame, but yeah, I'm going to go down a lower time frame first, the 2 hour time frame. So now there's a little more details as to what is making up that huge bullish push, right? As we were on the daily and weekly time frame, you saw it was just nothing but black bullish candles. So here's how you can understand how the market moves as such. Right here we have a high low point where this blue arc is. I'm going to continue adding these so you can see these market movements clearly. We have another high low point here. We have a higher high point right here. Let me move this. Right? If you don't already see, it's like this. High, higher low, higher high, higher low. And what's next? A higher high. You guessed it, because we're in an uptrend, right? Now, for the market to continue bullish in this uptrend to move in a bull market, in a bullish trend, has to make a series of higher highs and higher lows, just like this example I'm showing. If it's not doing this on any time frame, by the way, you know, structure on all time frames, higher time frame, lower time frame, 30-minute, 5-minute, 1-minute, it's all structured. In order for an uptrend to be an uptrend, it has to be doing this. If it's not doing this, it's not in an uptrend yet. It's not trending yet. You know, it needs to be very clear and very precise. When the market isn't very clear, you know, most likely isn't it. And obviously this is a clear uptrend. So I'm gonna go down to one more time frame lower than 1 hour time frame. Higher low point here. Respect to this previous high, which is okay, because in an uptrend it doesn't have to make higher. Sometimes it doesn't have to make the higher high on the first attempt, as long as it doesn't break the previous low. As long as it doesn't make a lower low point in the series of movements, then the market is still following the trend, still following the bullish momentum. Next, a higher high, and I'm going to stop here for now, because this is where things start moving sideways. But here is just clear market direction, clear trend, and this is the example I'm trying to show right here. So let me finish adding these arrows here. Now you can catch these little series of movements on the time frame that I'm showing on now, like the 1 hour, 2 hour, 4 hour, even 30-minute, 15-minute. You know, these would be considered scalp trades or intraday trades. And to catch this overall kind of higher time frame move, you would have to understand how structure works on the higher time frame, as well as the lower time frame, and using time frame correlation and knowing where certain key levels are in the market. Okay, so I'm not going to be going over trade examples in this video. I'll be going over the trade examples in the time frame correlation video. However, as you can see, this lower time frame is building up that entire higher time frame bullish move. You couldn't see all these details in the higher time frame because it's just one large singular candle in one direction. But if you go to these lower time frames, you can clearly see lots of movements, lots of higher lows and higher highs, bullish candles, bearish candles. The market is clearly trending up and down. Now you're using these lower time frames to find your entry points, as well as find areas the market can continue from, for you to take these trades. So for example, if you know about support and resistance and key levels, I'm going to add the little link right here so you can watch my most recent video on that if you have no understanding of that or need a bit clearer understanding of that concept. But you can see there is a level of support right here where this higher low point was made, right? And after that we hit some resistance, which would be another key level, minor time frame key level, lower time frame key level on the 30-minute. And in order for the market to continue trending, it needs to respect support, create a higher low on these areas, and then break resistance by making a higher high, right? So we created support here, market pushed and hit this blue line of resistance here, came down, created this level of support on this higher low point that the market was struggling to go down lower from. Then after that, it came back to attempt to break this previous level of resistance, right? You can see that it hit 3 times, and then on this final attempt, we blasted through. So after the market was trending bullish, we hit another level of resistance here, which ended up being a level of support later on, after the next series of movements. But after the resistance broke, we came back, tried to find a new major level of support somewhere, which ended up being right back into the breakout point essentially. And that's typically how the market moves a lot of times. Have a breakout move, and then it comes back to retest that certain area that it broke out from in order to continue with the overall momentum that it was just going in, right? So as you can see, it went bullish, then had a bearish correction, it came back down to retest where it broke out from. One could enter on this level or in this area in anticipation of this concept or anticipation of these movements, and then entered, caught the buys and caught the next wave or leg up. And to understand this, you're using your understanding of the lower time frame is vital to getting these entries, because that's how you're able to use tighter stop losses and get a more precise entry. Because if you're just looking at the higher time frame, you're not going to be able to catch these wicks or these wick entries on the levels or close to the low point. And that's okay, you're not always going to get the lowest best price, but the whole name of the game is to buy low and sell high essentially. So you want to be getting the best risk to reward that you can, and by understanding how the lower time frame makes up the higher time frame candles, you can take advantage of certain movements of the market. Not only can you get tighter entries, but you can continually add entries on the way up as long as the trend is still valid, or you can catch multiple trades. You entered here, that's 2 separate trades you could have got in because you were anticipating that the market was going to go up to this point up here. Now, to use this to your advantage, it depends on what your trading style is. If you're an intraday trader, if you're a higher time frame trader, it doesn't totally matter because you have to have a strong understanding of this concept. But your criteria for entering trades is different than it is for higher time frame traders and lower, and vice versa, right? And that would be certain levels, certain key levels based off of certain areas of the market, based off higher time frame levels or off intraday levels, and so on and so forth. But if you are a scalper or intraday trader, then understanding this concept is very helpful for you, because you're not going to be in trades for days at a time. You're only going to be in for 15, 30 minutes, an hour, 4 hours, 12 hours at the max. That's what an intraday trader does. And 12 hours is quite a long time, to be totally honest. And that'd be if you got caught early on like Asian session and it's just consolidating and you're just holding and waiting until the London session comes around, and whatever the situation may be. But really, these are just shorter time frame trades, short-term trades. So if you can understand how these lower time frames are playing out, you can catch multiple opportunities, such as where these blue arcs are, right? So you understanding how the market moves, you can go, okay, trade 1, exit. All right, trade 2, or scale in, trade 1, trade 2, and then exit up here. And then you're like, okay, let's find the next entry point. I know that's going to retest somewhere right around here. Okay, boom, caught this entry. Trade 3, so on and so forth. Understanding these concepts, you're able to really take advantage of these market movements more often than would you not without a greater understanding of market structure and key levels and time frame correlation. Now, not everyone is going to understand this concept right away because it's very easy to get lost in these little details, right? There's a lot more movements. But with time and chart time and analyzing the charts, marking these up regularly, your eyes are going to be trained to see this. And you're going to start recognizing candle patterns and certain market behaviors on the lower time frame and the higher time frame. And that's how you're going to be able to take advantage of these trades. But you have to execute and backtest and, really be passionate about the learning process and the journey of this whole entire thing. Now, that's all I have for this video, guys. Hope you guys really enjoyed and learned a lot from this. Stay tuned for the next video on time frame correlation. Don't forget to like and subscribe, as well as follow on the Instagram. And hope you guys have a great rest of your trading week. Peace.